Hello, everyone, and welcome to the Growing Your Wealth with Passive Real Estate Investments. I'm Rochelle, and I'm going to kick things off for you this evening. We've got a great bit of content to share with you today, and we are super excited that you guys have taken time out of your busy schedules to join us this evening. We know how precious time is and how stretched we all are to get everything done in a day, so we're really honored that you've decided to spend an hour of your busy schedules with us this evening. So we would love to hear from you and where you're from. So if you wouldn't mind putting your name and location in the chat, we would love that, as well as let us know why you're here. We want to know what it is you want to learn from this webinar this evening, and we'll make sure that as time permits, we will cover any questions that you have. So put those questions in the chat, and then, as I mentioned, let us know why you're here, as well as your name and your location. We've got a great bit of content to share with you. We're going to talk through the difference between active investing versus passive investing. We're going to talk about the types of returns that you can earn as a passive investor, 3 different methods for investing passively, why the sponsor is as important or even more important than the deal, 4 steps you can take to commit to your first or next passive investment, and what happens after the deal has closed and you are part owner in an apartment complex. So before we jump into our content, I want to introduce the team that we have here tonight. I'm Rochelle McCoy with Titanium Investments. I've been investing in real estate since 2017 and currently own over 64 units. That's a mix of multifamily, single family, some large multifamily, small multifamily, single family, as well as some short-term rentals as well, commonly referred to as Airbnbs. I enjoy, in my free time, I enjoy running, which pairs nicely with me having 3 very active boys. I chase my boys a lot, so I run for fun and I chase children. I'm also a semi-professional chauffeur for my children and all of their activities, so lots going on there. I also really enjoy volunteering for St. Jude Children's Research Hospital as well, one of my passions. Next, I'm going to introduce Mike Marowski. Mike is a 30-year real estate investment veteran. He's controlled over $285 million in real estate transactions, along with being an entrepreneur, author, real estate trainer, public speaker, and personal coach with a strong resilience. His deep desire to help others live an extraordinary life is evident in his day-to-day work, coaching hundreds of real estate investors to fulfill their dreams. Mike has owned over 4,000 units in 5 different US markets and has also built and developed a property management company that has managed over 7,500 units. Kevin Dugan comes to us from the Altus Investment Group. Kevin is a self-professed serial entrepreneur and currently the owner-operator of the Altus Investment Group, Urban REI Property Management, Altus Builders Company, and managing partner of the Bolt ATM Fund with 35 million AUM. Kevin has been an out-of-state investor from California since 2012. He's a full-time project manager and sales engineer at an industrial robotics company. Since 2012, his real estate journey is focused on out-of-state markets where he's flipped houses and wholesaled residential buildings in the Chicago metro. In 2017, he started the next progression of investments into value-add rentals, short-term rentals, property management, and general construction. 2018, he entered the multifamily sector, and since then has grown to help to manage a meetup that has grown to over 8,000 members and is continuing to grow his portfolio today. So with that, I'm going to hand it over to Mike, who's going to take you into our first topic.
Hey, thanks, Rochelle. Appreciate that. And Kevin, good to see you tonight as well. Glad that everybody is here online and looking forward to a fun evening here tonight. I'm going to talk a little bit about multifamily real estate and why we think it's a good time to invest right now. I always say that there's 2 times you can plant a tree, right? You can plant a tree 20 years ago, or you can plant a tree today. And I think in the environment that we're in today, this is a great time to be getting involved. Opportunity sometimes is or short-lived. And multifamily real estate today is the sexy asset class out there. Everybody wants to be involved in it. The average investor needs to be connected to a solid sponsor with relationships to get deals done. Multifamily really becomes your strong hedge against the inflation. And if you've been watching the stock market lately and you see the cost of gas going up, skyrocketing, I put gas in my car this week in Chicago, just about $5 a gallon. The cost of milk is up. The cost of bread is up. Real estate is up for sure. Supply chain constraints are causing supply and demand issues. And when you're invested in real estate during these turbulent times, you're going to see that hedge against that inflation. Our goal as passive investors, or to help you as passive investors, is to protect you from any losses, but to help you gain cash flow and long-term wealth. There's currently a housing shortage in this country, and we'll talk about that a little bit more, but there's a strong demand for affordable housing. Right now, there's more cranes and temporary fences up in most cities in this country. And they say that if all those units that are being built right now were delivered to the marketplace, there would still be a shortage. Cash flow and depreciation, and tax benefits protect your capital. So I want to say that again. The cash flow that we throw off from passive investments, the appreciation in apartments, and the depreciation, which incurs the tax benefits that you receive, will protect your capital. This is why multifamily is the best investment in the planet right now. You're going to achieve portfolio diversification. You have the ability, according to TradeStation, multifamily returns historically surpass the stock market. So in multifamily, there's 3 ways to earn a return. You're going to earn it through cash flow, through appreciation, and depreciation. You know what? The bottom line is people always need a place to live, right? Rochelle, could you flip to the next slide? Let me explain the difference between active and passive investing. When considering being an active investor, consider the time commitment, the education that you need to get, the grit needed to get the deal done, and then to manage and hold those deals for 3 to 7 years. Anyone can do it, right? If you want to take the time. In its simplest explanation, you have to deal with all the day-to-day activities like tenants, trash, and toilets. As an active investor, this is direct ownership. You're put on the title. You're going to locate the deal. You're going to underwrite it. You're going to do all the due diligence. You're going to plan for the exit. You're going to get the financing done. You're going to get to closing. You're going to do all the renovations, all the accounting, and then finally the disposition at the end. There's a lot of time involved, right? As a passive investor, you acquire a stake of ownership in an offering that gets put out there by a good sponsor, and you're going to receive interest in that partnership. And this gives you the right to the profits, to the appreciation. In many cases, that's the lion's share of those returns, with the sponsor and managers handling all the day-to-day activities, like I said, the tenants, trash, and toilets. And you may ask, why would I invest in a deal if I can do this all on my own, right? Maybe you think you can make more money. But here's the question I would say to you is, can you really make more money on your own? Here's a story of a woman that we've worked with. She was an active investor. She controlled a lot of her own real estate. She was a flipper in the single family market. But here's what we noticed about her is she was starting to get weary and really tired of being involved like that. She became willing, though, to give up some of that control. She wanted to relax a little more, take some of her time back in her own life for more important things like family, vacations, maybe some other activities that she had in mind. Passive investing allowed her to do that. She gained back control of her life again, got rid of all those single family assets, and started to invest passively in multifamily and a couple of other asset classes. Placing her investment money into a fund or a syndication that she just owned shares in, she was able to participate in bigger deals. Instead of one-off units, now she's investing in 200 and 300 unit deals. This gave her a lot of luxury. So let me ask you, isn't that what you're looking for and why you're here tonight? Maybe you don't have the time or the resources or the experience or even the education to really get into real estate investing on your own. And as an active investor, there's that huge time commitment here. You know, think this through for a minute. Think about 1,000 hours in finding deals. Hey, I underwrote 80 deals to write 7 letters of intent, LOIs. Those are offers to purchase. We wound up getting 1 deal as a result of those 80 deals. It was hours and hours of negotiations, hours of due diligence, hours of underwriting, hours of looking for funding, the administrative work, the legal work. Hey, listen, I'm not a doomsday expert and telling you not to do this, but I am saying that passive investing makes your life a lot easier. And do you have that time in your life to do all those active duties? As a passive investor, you're going to look for the deal, or you're going to look at the deal that's offered by the sponsor. You're going to get to read the paperwork, vet the sponsor, make sure that you're comfortable with the sponsorship team, vet the deal, review and sign the paperwork, fund your investment, and sit back and get your quarterly returns and a nice big dividend at the end. Okay, Rochelle. So every deal is different, but here's what you can typically expect from projected returns on a multifamily syndication offering. And I'm going to kind of just give you a brief overview, but an average annual return, you might look at something maybe between 15 to 20%. An internal rate of return, and the difference between an average return and an internal rate of return is the time that your capital is tied up. So your internal rate of return is going to be somewhere between 13 to 18%. The difference is that time value of money. And you're also going to see a preferred return along the way of somewhere between 6 to 10%. Now, those typical returns or that preferred cash on cash typically gets paid out on a quarterly basis. So you can build a portfolio for yourself through diversified properties. Passive investing allows you to invest in different markets, different strategies, different asset classes, whether they're value add or core plus properties. You can pick geographic locations, investment sizes, and see different types of payout structures. You can vet all of this on your own. As a sponsorship team, Kevin, Rochelle, and myself, we love high rent growth markets that are not oversaturated. Here, let me give you an example. Right now, we're focused and concentrated on the Florida market. And if you looked at the corridor between Tampa and Orlando, you have 1,000 people a day moving to that market. What happens is it creates new jobs. Because new jobs get created, it increases average household income in the area, which allows us for huge rent growths. Florida is not the only market that we look in. We look at the top markets. We're looking in Texas, Alabama, Arizona. You know, we kind of like to say, hey, it's the smile of the US between Charlotte and Dallas. You know, as a passive investor, you need to know about markets, market growth, the stability that you find in those markets, the stability you can find in the property. Look at the value that those properties in those markets are going to create. Know the deal. So when you get an offering, make sure you do the research, vet it. Know your team. Vet the sponsorship team. You know, we have a great team put together because what we've done is each one of us complements the other one. I know my strengths and weaknesses, and I also know that Rochelle and Kevin fill those gaps for me, and they're great team members. You know, experience is not learned, but it's earned over time. And we know that what we've done over the years to date and what we continue to do moving forward lets us earn that from our passive investors. I'm going to go ahead and turn this over to Kevin now and let him fill in some blanks.
Awesome. Thanks a lot, Mike. Incredible information. You know, really why we're here today is to educate people on a relationship with real estate. There's a lot of ways that you can become involved in real estate. It's not as complicated as you may think. So I'm a firm believer that everybody should be an investor in this world. You invest in your friends, your family, in your own education. Obviously, we're pretty biased towards real estate in the multifamily side. And coming from somebody like myself, who's an active investor, I'm an operator, I own a construction company, property management company, I'm constantly doing deals. I wish I would have known about passive investing a long time ago, because it would have given me an opportunity to actually earn money and learn from those with a lot more experience than me, and get exposure to deals and projects that are that would have been above my experience level. So when it comes to understanding how to find a good deal, there's a couple things from a high level that you want to understand. You need to know the markets that you want to invest in. Mike touched base on that lightly. You want to understand the deal that you're going to potentially invest in, and then vetting the sponsors. That's absolutely critical. Knowing the personnel who are actually going to operate the project. So as Mike mentioned before, the market. When it comes to markets, we do focus on a lot of the smile states because it's all about growth. From a really, really simple perspective, it's supply and demand. Where are people moving to is going to create demand for the real estate. And when there's demand for the real estate, the prices are going to go up. But within those markets, Texas, there's Houston, Austin, San Antonio, Dallas, large markets, lots of people moving from California. Arizona has Tucson, Phoenix. You have Alabama, you have the Carolinas, Florida. All of these locations have been thriving over the last couple of years, and especially during the past couple of years with the pandemic, there's been net migration to these states. When you get into these actual markets, you want to do some deeper analysis as to okay, where are the universities at? Where are the major medical centers? Where are the attractions? Where are the beaches? Because land, is pretty traditional. People are going to go and thrive where there's the most need for that particular real estate. So you want to get granular on, is there a path of progress? Is there more development going around those regions? And is that property going to increase in demand over time? Understanding the deal. Once again, we're really focused on multifamily because there is a massive shortage of affordable housing here in the US. I believe it's 2,000 doors or households that need to be created right now, both on the residential side, apartment side. This shortage and deficit was created because of the last 2008 correction. Builders didn't produce more product, and because they didn't produce, now we have this huge shortage that's hitting a lot of millennials right now. So the affordable housing is absolutely critical. Multifamily, when it comes to understanding the deal, is essential. And when it comes to understanding the deal, you want to see your underwriting analysis. So are their assumptions correct? Are they projecting the right type of rental growth in the market? Are they using the right comparables to show where it could go from this particular project? Are they expecting the expenses to be reasonable? Because when it comes to it, you really need to know the financials by asking questions. You can ask questions to the sponsorship team on how they came to their numbers, especially if you're not savvy. You can definitely ask us. We would give you a perspective and take on how to make sure a deal is looking clean from an underwriting perspective. And ultimately, knowing why the investment thesis would work for a project. We invest in a lot of value add real estate, which would be along the lines of, an operation where we need to put in a professional management company, or all the units need to be updated. So there's a lot of reasons as to why you would look for a particular deal. Feel free to ask us for more detailed questions on how to, vet a deal, a market, or even a sponsor. On the sponsorship side, this is actually one of my most important topics to discuss, because at the end of the day, when it comes to real estate, it's not a liquid asset. When you get into a deal with somebody, it takes time to buy it, months to buy it. And when it takes time to sell, it takes months to sell it. And usually there's some sort of period where you have to improve the value of the asset over time. So plan on being in a relationship with somebody for 2 to 7 years. You really need to like that individual. You want to know their background. How much experience do they have in real estate? Have they been through a real estate correction? Have they lost money? I've lost money in real estate deals. I don't lose money anymore, but I've lost money in the past. And those experiences have hardened me in terms of the way I look and analyze deal from a cash flow perspective. We have a construction company, property manager. So all of those elements come into play. How much money is the team putting into the deal? Who are their property management companies, their contractors they're bringing on board to execute the project? So these are all questions where you talk to the sponsorship team, you get a feel for who they are as individuals, and you gain confidence that they can actually execute the business plan that they are presenting. So I'm going to talk about a couple ways that we can invest passively in deals. So when it comes down to it, you can invest in deals in a couple of different structures. There's yourself or your family as individuals, and then there's the entity type structure. So, if you have an LLC or a trust, those are going to be, quote unquote, entities that are investing your dollars. Of course, there's cash. For any of these types of projects, you have to bring some sort of liquid assets to the table. You could use cryptocurrency, then convert to cash and buy something hypothetically. But that money has to go into the deal to be able to fund the down payment plus the rehab costs for a lot of these projects. So when it comes down to it, those are the major sources of income. However, I want to talk about a category that a lot of people aren't thinking about. It's the retirement accounts. And I'm guilty of this as well myself. I didn't realize that there were options to utilize self-directed IRAs. Or a solo 401k, or if you had an employer with a 401k, you can convert that 401k when you go to a new employer to a self-directed 401k. And pretty much these are qualified retirement accounts. You have the ability to convert them into what's called a self-directed asset. And when it's self-directed, you have to use a custodian. It's a third-party company. We have some referrals if you need them, where they can actually take your funds independent of you, well, your choice. You tell them to deploy funds, and then they will have to move those funds into an investment of your choice. It doesn't have to be real estate. You can buy gold with it. You can buy individual stocks. You can buy cryptocurrency. You can invest in people's startups. You can do anything you want with this qualified retirement account. But the important things to realize is you can control your financial EQRPs. I believe so, yes. So don't quote me on that one. I will have to get back to you on the EQRPs. But ultimately, you aren't just limited to some sort of mutual fund from your 401k. You have a lot of different options where you can control your retirement accounts and invest in real estate and grow that wealth significantly. There's, if anybody has some time, look at Mitt Romney. He has $102 million in his Roth IRA. And how does that happen? Well, there's some tricks to the trade on being able to invest in ridiculous deals like startup companies in your retirement accounts. We're biased towards real estate here, but just know there's other options. So I'm going to jump over to the next slide to show you a couple of the steps regarding how to get invested. And it's fairly simple. So after you've done the bulk of your research, which is in researching the market, the deal, and the people, that's the bulk of your responsibility as a passive investor. The next thing you'd have to do is register, go to a webinar. If you're interested in register your commitment, so say you're interested in doing that, you would sign the documents for that. It's called a PPM, a private placement memorandum that outlines all the details. They're usually really long, so you can ask your investment specialist what the details are, the pros, the cons, the upside. You'd wire the funds to the deal. The investment team will close on the project and you get to sit back and relax and collect those quarterly checks. So it's a really simple process from that standpoint. Of course, there's a lot of back-end details that active real estate investors like ourselves handle. But to simplify the process, register commitment, sign documents, wire the funds, and then just chill. All right, Rochelle, take us home.
Awesome. Thank you, Kevin. So Kevin brought us in and we've now closed on the deal, and congratulations, you own an apartment complex. And you're probably thinking, oh, well, now what? Good question. Your job at this point is super, super easy. So your sponsors will send out communications about the project, the overall status, what's going on with the construction and renovation. You know, usually there's a big stabilization period for these types of projects. So during that time, you'll get a lot of communications from your sponsors, probably on a monthly basis. That may, you know, kind of taper off to quarterly communications once that property is fully stabilized. And then usually after a few quarters, again, you know, during that early part of the stabilization period, after a few quarters, you'll start to receive distributions from the sponsors as well. And that's really it. I mean, your job as a passive investor is so easy. Make sure you keep up on the communications. If they, good sponsors will also do quarterly webinars, so you can ask questions about things that are going on with the project, and sit back, relax, and enjoy these distributions. So the next segment we're going to go into this evening is a quick case study on a property that we own down in Tampa, Florida. And we wanted to share kind of a real world scenario with you so you can better understand how these different tools and this information we've shared with you translate into an actual property or an actual deal that's out there. So with that, we're going to talk about our terrace properties. We purchased a set of, it's a 40 unit total, 2 different properties down in Tampa, Florida. And it's a kind of a traditional value add play where we're going to go in. We found a property that had some deferred maintenance. It had been owned by the same kind of mom and pop owners for about a decade. They didn't really do much to the property. They raised the rents a little, but not much. They really didn't push those rents up to the market rates. They did, as you know, the bare minimum when it came to maintenance. They really didn't do any major improvements to the property in order for them to drive those rents up. So for folks like us that are looking to do a value add deal, this is a prime opportunity to go in, take over the property, manage it as efficiently as possible, do some updates, some renovations, and really be able to drive up the rents and the income on that property to generate great returns for everyone involved in the project. So, so the deal is really important. As you guys know, we've already talked about that. Also selecting the market is super, super important as well. So we make sure that any place we're investing is going to have good growth in terms of economic growth, jobs, diversity of employment, make sure it's got good population growth. And we also look for areas that have a good level of gentrification happening, where there's you know, a lot of new development or things happening in the area that show positive economic growth. So those are all things that we look for in terms of, you know, the type of deal, and also you know, a few bits into kind of how we evaluate the market when we're looking at this type of opportunity. And then the next thing really is the business plan. So putting together an overall plan and structure so that once we acquire the property, we can go in and very efficiently, you know, do those renovations and improve that income and lower those expenses and do all the things that are going to make this a great opportunity and a great deal for all of the investors. So next, I'm going to pass it off to Mike, and he's going to walk you through a financial summary.
Hey, thanks, Rochelle. And one thing I just want to reiterate, you know, if on that last slide, you may have seen on the date that said it was built in Rochelle, can you go back to the last slide for a minute? I just want to show something real quick. On the bottom of that slide, it says that the date, I don't know what happened to the slide now. The date, it was built in 1969 and renovated in 1980. When the date is set out like that, that's what that means. So what's interesting is we really like value add. Go ahead, you can go to the next one. We really like value add properties. And this property is a heavy lift that really gives us the opportunity to do that. And you'll see by the numbers how we're getting there. You could see what the purchase price was, the debt we put on it, the amount of equity that we're raising, and then what the capital expenditures are. And that's interior, exterior renovations, redoing with the curb appeal operations, making it look different. And so as a result of that, you can see at purchase those numbers when we first went in. Our gross rents are $430,000, and I won't talk into change, and our expenses are $173,000. So that left us an NOI, a net operating income of $217,000. But after our projections are that by the end of the first year, that we're going to see our NOI, that net operating income, grow to $249,000. So subsequently, what does that do? It increases the asset value. It takes it from the 4.6 that we bought it at to 5.9, just about 5 million, or I'm sorry, 4.9, just about $5 million. But here's what's even more fascinating. Because of the appreciation, because of the accelerated appreciation through the capital improvements, by the end of year 5, we'll see that NOI grow to $450,000 in cash flow, which gives an asset value of about $9 million to that property. So anybody who takes this ride with us gets that opportunity to partake in that cash flow along the way, plus that larger sale price at the end. And you can see at the bottom that we purchased this at a 4.7 cap. And our projections on exit, because we believe that the market is going to decompress a little bit and those cap rates are going to rise up. Cap rates are an inversion, and I'm not going to get into that. But as those cap rates rise up, we're going to be able to still sell this out based on market value at a higher profit.
Hey, Mike, mind if I jump in here really quickly?
Yeah, go ahead.
So just so that everybody knows, when it comes to commercial buildings, like an office, a self-storage, a new construction, an apartment building, the values of these buildings are based on how much net income it generates and the trading cap rate. So that's where the beauty of real estate is, especially commercial. You have this multiplying effect. For every dollar we increase, every net dollar we bring in at the end of the year is multiplied times 20 for the value. So that's why there's this powerful leverage of the value add strategy.
Yeah, thanks, Kevin. Appreciate that. So the next slide here will give us an example of what those returns will look like. If you rode this whole ride with us, you got involved, and we're going to use $100,000 average investment just because it's easy math. But at an 8% cash on cash return, a preferred return, you're going to receive $8,000 a year. The reason in year 1 you're seeing that decrease is because for 2 quarters, we're going to hold back cash flow or payouts because we're going to use that to build the reserves up in the property, and we're going to play catch up. So at the end, you being a preferred investor in a passive investment will give you the opportunity to catch up. You'll get that additional $4,000 back. So the proceeds at sale will give you about $111,000 in profit over and above that. So your total return, which includes your $100,000 initial investment, will be about $267,000 at the end of year 7. So I'm going to go ahead and turn this over to Kevin now.
Cool. So when it comes to real estate, there's a lot of different strategies. You know, with Mike and I, Rochelle, having such a deep experience with property management, construction management, the ability to find a diamond in the rough with that value add opportunity is what we look for. And this project that we had found in the past was an operation that was owned by a wife and her husband. They were not professionals by any means. They didn't believe in any type of, investment into the asset to be able to make the project look beautiful. And they just deferred everything. They were really attracting a difficult tenant base. So value add opportunity means like we can put in professional management, we can upgrade the interior units. You can see right here with these pictures that it's looking drab and dreary. there are a lot of lost leads because they're attracting low quality energy tenants. And what we saw in the market when we drove out there to do competitive analysis with other apartment buildings, that we could increase these rents significantly. And then on top of it, because of where the asset was located, to theme parks, to the university, to some medical centers, I have an Airbnb superhost status. I was like, oh, okay, this is like prime for being able to do something Airbnb short-term rental, since it's a hot topic. If we jump over to the next slide, it shows some of the exterior changes and transformations that can go on. So if you look on the left-hand side, that's the before pictures. On the right-hand side, that's the renderings, but we've actually done some of that work already. So when you see a building and you got a gray building, a pink building, a green building, and then green buildings, like that's money right there. Just if anybody's seen that. Same thing with if you go into a house to try and flip it and you see a pink on the walls and like the pink tiles and like that's 1970s vibes, like it's no longer hot. Like it may circle back in 10 years from now, but right now we're going for like the HDTV, like modern grays. So really simple transformation just to attract the right type of tenants, people who have like pride of ownership of living in that apartment complex. Going over to the next slide, some of the interior upgrades that we're going to show. Once again, the before, we got the pink walls, purples, greens. That's actually one unit. It wasn't terrible, but still, that's not something to just attract the masses. So we went for like the neutral grays, modern light fixtures. We put stainless steel packages, upgraded the vanity. Once again, you want to have a place where people can call it their home, because if not, they're going to move in every year and you're going to have vacancies and turnover costs, and it just ends up costing a lot more. So this is just an idea of like a quick interior value add. It's a fairly simple turnaround when we took a look at it. Lastly, we're going to talk about some of the asset management here. And this is one of the critical element to being able to execute on real estate. At the end of the day, can the team execute on the business plan? And we've been able to put together a fantastic team in Florida. Our property management company is really on point. They're communicating with us weekly, giving us the weekly reports. We've identified all the challenging tenants. We're releasing for the great tenants that we want to keep. And then our contractor also is on point, especially nowadays. It's a weird market in general. It's a seller's market. Inventory's low, contractors are in high demand. So to hold the attention of your critical team players in a different market is nice. And to execute on the asset, that's what's needed to actually turn the units around, to keep the momentum going, to keep the progress going forward so that you can, hopefully move all the units to the market rents, which we're projecting right now. So pass it off to Rochelle and she'll take us away.
Awesome. Thank you, Kevin. Really appreciate it. So that's all the content we had to share with you today. I hope you guys enjoyed this and found some good, useful information that can help you move forward in your journey as a passive investor. We have a fun quiz that you are more than welcome to take. I'm going to throw the link to that in the chat so you have it handy. This quiz, it's I think about 10 questions long, maybe 12, and will help you decide if you might be better served as a passive investor versus an active investor. So we encourage you to go and take that fun quiz. And if there's any questions in the chat, we can go ahead and take those now as well.
And if not, you can always raise your hand and I think Rochelle can unmute you as well. And just to buy some time over here, I just really want to encourage everybody to at least start thinking about how they can involve real estate into their life. Because I know it's changed my life, it's changed Mike and Rochelle's. And it's one of those things where you can take it at your own pace. You can buy any type of real estate. You can be an active investor or a passive investor. It's the options are endless, but taking the step to enter a deal is critical, especially in today's market. Being passive is a recommendation because it's a complex market out there. And we're a wealth of knowledge. I'm always willing to give my time to help out and educate. So if there's any questions.
Yes.
Yeah.
Paul, you can unmute.
Mike, you want to answer this one for Matthew?
Oh, yeah, I'd love to answer this one. Hey, great question, Matthew. Paul, I don't know if you were able to unmute, but just 1 second, we'll come right back to you. Matthew, I think I mentioned it earlier. I had been underwriting a lot of opportunities, a lot of deals, and had underwritten probably close to 80. And Kevin and I had been working with an analyst who has been helping us do that. And we were walking through, wrote a few LOIs. You know, I always say that I wrote 7 LOIs. I was the bridesmaid 6 times and finally got to the altar on 1. But here's what happened. Kevin and I figured out early on that we were not going to be able to handle all the moving parts. If you were to sit down and take a multifamily property and everything that goes into that and write a list of everything that has to happen as an active investor, as a GP or a general partner, and figure out what you're good at and what you're not good at, and then go find somebody who is good at that. So I went to Kevin, I said, hey, we have this great deal. I know you're great with construction, and let's underwrite this thing together and really crunch the numbers. We tossed it back and forth. We learned very quickly that we weren't going to be able to handle everything. You know, one thing, a great example I always like to use is that, you know, a PPM or a private placement memorandum, typically 50 pages long. I fall asleep by page 30. Kevin is too busy to read them. So we had to go get somebody who could take care of all the compliance stuff for us. And we went and grabbed Rochelle and said, hey, do you want to join this team with us? And then we have a 4th partner also, who's a KP, a key principal that came to the table with a wealth of knowledge and experience, a lot of units under management, and a balance sheet that helped get the loan done. So you have to look at what you're good at, go out and find people that will help complement what you're good at, but fill the holes of what you're missing or not so good at. So that's really how we put our team together. And, you know, it's funny because I'm sitting here tonight listening to Kevin and Rochelle talk, and I'm thinking, man, you know, for the few months that we've been together really working on this stuff, we've really come together as a sponsorship team. I think we complement each other on a lot of areas and continue to grow as a team. So I know that going through this year that as we continue to get our arms around Tampa and move forward buying some other units and some other properties, that we'll have a great year as a good team. So if you want to join us, we'd love to have you. Paul, if you want to go ahead and unmute and jump in. You know, Paul, if you can't, I don't know if it's not working for you or what, but if you want to try and maybe throw a question in the chat, we could try and get an answer for you, or anybody else, if you have questions, you want to raise your hand.
Tyler's asking, how are we modeling takeout financing assumptions in today's interest rate market? So the takeout financing assumptions.
Well, when you mean takeout, I'm hoping that you mean at the end when we go to sell this, and those takeout assumptions. You know, a lot of discussion around this, and you really try to project that on what you think, you know, the cap rate is going to be at the end. So in 7 years from now, what's the cap rate going to be? So here's how I look at my math when I do this. A lot of times, you know, and I hate to say it might be throwing a dart at a dartboard, trying to pick a number. Because you really, unless you've got a crystal ball and you can see where the market's going to be in 5 years from now, 7 years from now, it's tough to tell. But here's how we use our math. So we bought this at a 4.7 cap. I really thought that we would see the market compress more over, you know, 2 years of owning the property, somewhere between 50 to 100 basis points, which would take us down to probably around a 3.7 cap. And then what we started to look at was what the increase would be year after year moving forward. So if it took 2 years to take a 4.7 cap down to 3.7, And now I'm going to still hold that deal for 5 more years, which would give us the 7 years. By the time I get out, I'm another 125 basis points above where I was, which puts us at about a 5.25 cap on exit. And that's really how we modeled that assumption around this to get us there. You have a lot of friends that are in the business, have been in the business for years and years, and have done a lot of research on that and had a lot of conversations with men and women trying to figure out the best way to manipulate the math that's going to be, as close as we can possibly get. And, you're never going to be perfect. And hopefully the market doesn't go back up, or the cap rates don't rise like that, but, and we'll still stay compressed, but chances are it's going to go up. And even at a raised cap rate, you can see what that exit price might be.
All right, we'll take a couple more questions here. Paul was asking, how do you handle seller financing in your deals? Loaded question.
I don't, I think it's a good question. I personally, I have done some creative financing on multifamily. Of course, in the single family sector, you can do creative financing, seller financing a lot. But a lot of times in the multifamily sector, all you have to do is ask if a seller wants to participate in the funding, if the seller wants to participate, maybe make a little bit more money than they're typically going to make it just a straight sale. I bought a 450 unit apartment complex one time that we quietly assumed the first mortgage. There was a couple of $1 million on a second mortgage that we gave the seller a small down payment on, and bought that down every 6 months for the next few years to take that seller out. So, every deal comes with a different strategy that you can look at. I always tell people, be creative, think outside the box. What would you like to see? And always create a win-win situation, Paul. Don't ever if you ever walk away from a deal feeling you got the upper hand or the seller got an upper hand, it doesn't win for anybody at that point.
So we got a couple more questions here. We'll have to get through them fairly quickly. Heath was asking, what net worth do you see most investors switching from investing as an individual to an entity, such as a trust or LLC? Trusts are always a fantastic way to just protect your family's wealth in general, because you can pass that on to your family without any major tax liabilities. If you start to have multiple investments and you're growing that fund pretty significantly, people switch over to an LLC, because you can start to put everything in this passive investment bucket. So once you get a multiple investments, it can even be multifamily plus residential. It's in that bucket on its own.
I like this one, Kevin, about the annualized return on Waterfall.
Yep.
And the question to that is yes. And the reason that we as a sponsorship team like it is because we get to participate and make money as that waterfall kicks in. So it causes us as a sponsorship team to work a little bit harder to make the property perform better, to get the construction done so that we can increase rent, create more cash flow, because then when that waterfall kicks in, and just so everybody understands what that is, if you're not sure on a waterfall, we come out of the gate saying, hey, there'll be an 8% preferred return. But if we go between 8 and 12%, it changes. If it goes between 12 and 15%, everybody makes more money as a result of that. So it causes us as a sponsorship team to work harder. Yes, we do like it, is the short answer. How we set up LPs, returns, that LLC is a split up into A, B shares. The A shares are the LP or the limited partner, the equity investor. They tend to get the lion's portion, might be a 70 to 30%, 80, 20%, depending on the deal that you invest in. And the LP or that limited partner gets the lion's share, gets all the preferred returns along the way.
Hey, Joe, circle back on your question. The waterfall structure makes sure that there's alignment with the investor sponsorship team and the passive investor. So, when there's a waterfall structure, our team would have to perform in order to actually get paid. So that's something you may want to consider. Tyler, in your question, like the most important metrics, it really depends on the investor. Everybody's experience and appetite is different. So some people are just looking for like, hey, how much money do I make on a monthly basis? Like, what's my quarterly or monthly cash flow? Some people just want big chunks of change. Some are looking for tax depreciation. So as a sponsorship team, we have to know how to communicate all of it and what all of it means relative to the importance of our investors. All right, we're getting at that 50-minute. I know everybody's been super patient here. I mean, from this standpoint, we really are grateful for everybody to come and increase their education tonight. And we hope that you reach out to us, and we'd love to help educate you even further. Of course, there's opportunities that we do have available. So we would love to chat with you more about this. Do you split the depreciation? Yes, you do. Typically, the LP side gets a lion's share of that. Any last comments, Mike or Rochelle?
No, I just want to thank everybody for being here tonight, and especially you two. And the questions were great tonight, which really helps a lot too. So glad that we could deliver that information.
Awesome, everybody. Thank you.
Good night.
Thanks, everyone. Have a great evening.
Take care.
Bye.
Bye.